Good morning, everyone, and welcome to Hein and Associates webinar, 5 Smart Practices to Take Your FP&A to the Next Level. I'm Jennifer Nichols, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use your chat feature to ask questions. We will save time at the end of the webinar for questions and answers. This event is being recorded, and a link to the recording will be sent out to all registrants later today. Your active participation is important throughout this session. In order to receive the CPE credit for this session, you must answer the polling questions included throughout the presentation. Our presenter today is Paul Thompson, Managing Consultant in Hein's Business Advisory Services practice, who has over 15 years of experience in financial planning and analysis. Paul provides FP&A for Hein's NetSuite and other cloud solutions in diverse industries. Thank you all for attending today, and I would like to introduce Paul.
Thank you, Jen, and thank you everyone that is attending today. As Jen said, we will be going over 5 smart practices to take your FP&A to the next level. Now, as we get started, before we go into the smart practices, I'd like to review the role of finance and where you might be at in your organization. Generally, accountants or finance professionals start out as accountants, and in smaller organizations, it's a lot of annual budgeting and financial accounting. They're very much focused in on transaction management, setting up the systems, getting things set up as far as how transactions flow through the accounting system and making sure everything ties out. So it's very detail-oriented. It can be very, in some respects, complex because you're building things from the ground up. You're looking at your business activities and moving those things over into information and data into the accounting side of things. As you kind of develop from there, you move into an area we call process managers, and this is where you start really focusing on improving the reporting, looking at variance reporting. So you're looking at maybe your annual budget, and you're comparing that to your results, your actuals, and doing some analysis that way. Very high level, very much dollar oriented. It's all about controls at this point, so you're trying to set up things like separation of duties and making sure all that fits and aligns with best practices in the accounting function. You also start looking at accounting from different disciplines like tax and audit and treasury and things like that in this stage. From this point, you move into an area we call business partners, and this is where you're starting to add more value to the organization. You're looking at more decision support and how can we take the accounting information that we're gathering and moving that into information that can be used by the decision makers and the management team. You get a lot more involved with financial analysis, although we'll talk about this later. It may not be as adequate as you want. It's still more than what you were doing before. You're also, at this point, starting to step away from doing things like annual budgets into rolling forecasts, and we can talk a little bit more about that, but updating those budgets as you go and plans as you go. You start delving into performance management. This is corporate performance management is a whole discipline in and of itself. It includes reporting and analysis and business intelligence and things like that. So you're moving into those areas, and then you're also looking at analysis of what drives the business, the drivers that will actually actuate your business plans and the dollars that are in that. What are you actually selling? What are you actually, what's driving your cost and that sort of thing. And then the final phase that we see a lot of organizations move into as they mature through this role of finance is to move into the area of business leaders. This is where finance is no longer just about support, but it actually becomes an integral part of the decision-making process and the leadership team. And they start adding real value, providing strong analysis on not only just financial pieces of the data, but also operations and strategic decision making within the organization. So in this area, it's really kind of moving away from the nuts and bolts of the day-to-day activity of finance and the planning side, and you're really opening it up to enterprise-wide collaboration where you're giving the operational managers access to the systems. They're able to have input into the process. They're able to do more self-service analysis and reporting and that sort of thing. And then they can also do some, what if planning, what if analysis and that sort of thing. So it really adds a lot of value to the organization. And then finance is really kind of there as leaders guiding them through these processes and through the operations of the organization. So very much a mature organization or a mature role of finance in the organization. So let's go ahead and start talking about the first SMART practice, and that is the use of rolling forecasts. I'm sure a lot of you, at least in your past, if not currently, have used annual budgets. And the annual budget is better than nothing for sure. It can be useful in a lot of ways, but the use of rolling forecasts answers a question about annual budgets that really is critical, and that's the timeliness of your numbers and the timeliness of the information. A study was done recently that says that 64% of annual targets are obsolete in 4 to 6 months. That was done by Beyond Budgeting Roundtable. I personally found in my career that was actually a long time for a budget to be valid. We saw a lot of times that our budgets were out of sync with reality 1 to 2 months in, and sometimes before we even got it approved by the board. And it's not that we were trying to hide information, it was just the time it took information to go from the front lines to the operating or to the planning system. There was such a lag there that information didn't flow accurately and timely in that sense. And so we found that our budgets were obsolete well before the 4 to 6 months. But this is a study that was done there. So one of the things that finance realizes as they go through this process is they need to know what that frontline manager knows about the business and how things are operating. So if you change a contract date and maybe you have a $5 million contract you signed, and instead of starting in April, it's now going to start in August. Well, that can significantly change the information. Well, you need to update that annual budget to be able to reflect the new reality, and that's critical and part of the SMART Practice 1 of use of rolling forecast. So before we go further, let's go ahead and move into our first polling question. Jen?
So the first polling question, how frequently are you forecasting? Monthly, quarterly, biannually, or annually? We'll give you a few seconds to answer, and then we'll move on.
All right, so it looks like about a third of you answered annually. About a third of you said monthly, so that's good. It's switching around a little bit more as more people are answering the questions. We've got some biannual and as well as some quarterly planning going on out there. So that's good, and so that's exactly what we were talking about. Rolling forecasts are critical because the plan should never be out of date. It should always be up to date with the latest information. It's kind of like a roadmap. If you have an outdated roadmap, you might end up in the wrong place, maybe the road's out or whatever, but you need to have that map or that plan, as it were, updated frequently, and that it should never be out of date. And then also, as you go through this process of rolling forecast, you're importing your actuals and using that to reforecast quickly or to compare to how you are so that you can get back on track to where you wanted to be. It's not that the annual budget or the snapshot at the end of the year is going to be invalid going forward. It's just that you want to use the reforecasting to guide yourself back onto that course. And then having everybody on the same sheet of music is very important. Understanding what's going on in the business from the same set of plans and financials is very critical. We have a couple quotes here. Always ready. I like the ability to manage versions so everyone is on the same sheet of music. When I get a call from management to do a forecast, I might have 24 to 48 hours, and now I'm always ready. That was a quote from Lori at Mendota. Now, before we go into the second one, I'm actually going to pop over into a application that we use that allows you to do that. This is a planning solution called Adaptive Insights. Adaptive Insights is a suite of corporate performance management solutions that include planning, consolidation, reporting, as well as a tool we call Discovery, which is more or less a business intelligence solution. And I'm just going to kind of give you a brief overview of how you can see using rolling forecast in this planning tool will help you. So I'm going to just pop in here to one of the menus. If you look in the menu stack here, everything is consolidated into one menu stack. So I'm looking at reporting here. I'm looking at the discovery. I've got my consolidation. Up here where it says sheets and assumptions, that's all my planning. So I'm not popping in and out of screens. I'm not having to go to different parts of the solution to get to different areas, different parts of the corporate performance management stack. It's all in one location, so I can easily navigate. If I pop into a expenses sheet here, one of the things that this allows me to do is I can navigate through my different business units or levels of the organization. Here I've actually got 3 companies that I'm using, or 4 companies here, and within that I've got different countries within company A. I've got operations, I've got sales. I can stack this any way my organization is laid out and navigate through that. One other important feature as far as the rolling forecast goes is I have the ability to create as many versions as I need to. Right now I'm in the 2015 working budget, but if I want to reforecast this, I just make a copy of the information, I rename it to something else, and then I can make changes to that copy without affecting the original budget, annual budget or the working budget. So I have here, for example, I have a Q1 forecast. It allows me to do that quickly because I'm not having to rebuild the budget or the plan from scratch. I'm going in and changing just the things that change the deltas in my plan. And I've heard from organizations where they did not do any kind of reforecasting in their annual process or in their planning process, and then they were able to do that once they had a tool like this to be able to do it in one day, just because all they were doing is making those changes where they were needed or on an as-needed basis. So this can help you do that is a great tool to help you to be able to do that. Now back over to smart practice number 2, automate KPIs, dashboards, and scorecards. And this really kind of gets into where as the finance role matures through the organization, you're able to add much more value and not just focus on financial aspects of the information, but also operational aspects of the information. And automating that helps you to be able to get the information to the end users on a timely basis and in a way that they can make decisions. If your reporting and KPI and dashboard process is monthly, you're missing out on a great opportunity to help the organization be agile and be able to make timely decisions. If you think about it, a lot of your business activity may be happening, let's say, the beginning of the month. By the time that gets recorded through the accounting process and then closed out at the end of the month, you're looking at sometimes up to 45 days out from the business activity to the results are reported. And that lag can be very expensive in terms of not making timely decisions and being able to react quickly to changing conditions and environments. So it's important that you automate these things so that those decisions can be made timely and accurately and effectively when they need to be made. Now we have our second polling question. Jen?
How long after close do you publish KPIs dashboards? 1 to 2 days, 2 to 5 days, 5 to 10 days, more than 10 days, or not producing at all? Again, we'll give you a couple seconds and then we'll move on.
All right, let's go ahead and look at the results here. It looks like a lot are publishing 5 to 10 days out. It looks like the majority. Some are not producing at all. A significant portion, 20%, are more than 10 days out. And then a handful of you are 1 to 2 days and 2 to 5 days. So very well dispersed here and pretty typical of results that we normally see. So it's important that you automate because you're spending less time collecting data and more time analyzing it. And in most organizations, there's that 80-20 rule where finance professionals are spending 80% of the time gathering data, collecting data, correcting it, cleaning it up, formatting it, making it into a useful information for the end users. And if you were able to look around the room, if we were in a room and to see everyone, I'm sure we would see a lot of heads nodding at this point because that's pretty typical. And what you want to do is reverse that. You want to be able to spend maybe 20% working with the data, and then 80% is analyzing the data and providing value-added details and direction and guidance on that information to the constituencies that you support and work with. So automating it can very much help you if you're able to integrate the data from systems, the source systems. That's even better, to be able to bring the data in on a timely basis and have that information not even have to interact with spreadsheets or things like that, just come directly from the system, is really the best way to do these things. And then visualizing your metrics is helpful because a lot of times we don't have time to sit there and think through, especially business operations managers, they don't have time to sit there and think through what does that information mean. They need to be able to see on a visualized basis and understand, okay, this changed or this went outside of the guidelines, and now I can see exactly when I need to make that make those decisions and change that course. Also, when you're going through this process, part of the role of finance is to build the acumen of the operations leadership, to be able to build their understanding of how their activities relate to the financial success of the organization. And that's done through the use of KPIs, or key performance indicators. The dashboards and scorecards that you develop can help tie out those relationships for those managers and then help them make better decisions and become more seasoned professionals in their own roles. Here we have a quote from Samuel. It says, rather than spending weeks of our time trying to develop reports in Excel, we can run reports in adaptive planning in a matter of minutes. So let's go ahead and pop again back over into adaptive, and let me show you what I mean by KPIs and dashboards and so forth that you're able to utilize. I'd go into discovery, which is our data visualization or business intelligence solution. As that comes up, I'm going to go in and change my month so we can go into a month that has good data. As I have made that change, you can see it automatically updates with the information that's in the database behind it. So automatically changes as I change the perspective or the month there. When I'm looking through the information, you can notice that I'm looking at a summary page. I've also got a sales tab, got a CRM tab, then production. These are all customizable to exactly what you need. But as I'm clicking through, you notice that not only where the visualization's changing, the type of dials that you can use in this type of solution change, but also the information that I was looking at. So here I'm looking at production or availability or downtime or the trends or availability here in a speedometer setting. If I was looking over at sales, I'm looking more on sales by geography or the average sales price, things like that. Or I can even put in basically tabular reports here and see information on that basis. Go back into the summary and show you as well how this information ties back. In the area of data analysis and business intelligence, what you want to try to do is see the data from different slices or viewpoints. And you add dimensionality to that data, which helps you then see exactly how that information or how that data came about, where it came from. In this case, I'm looking at revenue. So I'm going to go into revenue for March, and I'm going to go down and look at it from the standpoint of the location. And when I did that, it opened up another box and it showed me that I have so much in the US, UK, and Canada. If I wanted to drill through and see, okay, what is it by product line? Now I'm looking at product A, C, and B here as they stack out. If I wanted to drill into product line and go in and see product line A by customer, I can do that. Now, as I've been going through, I'm not losing my place. I understand exactly where I started and how I got to where I am. I'm looking at March revenue, looking at it in the U.S. for product group A, and I'm seeing it by customer. Good solution will allow you to do that without losing where that breadcrumb, if you will, that trail, to understand where you came from and how you got there. And then it also allows you to see that dimensionality of the data and understand where it came from and how the data was collected. Also, I can go into, for example, I've got a scorecard here, and I can see exactly how that scorecard, where this information came from, drill into it by saying explore data. When I do that, it opens up another tab in my browser. And then I can go through here and see exactly how this comes out. So I've got company A, B, and C, as we have in our organizational structure. Click into that, and I can keep drilling into the organizational structure. I'm going into the United States. Now I'm going to Sales North. And now I've crossed the line from the organizational structure. Now I'm into the GL area. So I'm looking at a roll-up of GL accounts. I'm just going to keep drilling through. As I go through, I get down to an area where I'm actually looking at a formula. Now this is referencing an account within the planning system that has formulas behind it. But it's important that this type of system allows you to do this, and now I've gone into where I'm actually seeing names for the salaries that we were looking at. It's important that you see this because that adds transparency to the information, because a lot of organizations spend an awful lot of time trying to gain confidence in the numbers and understanding, is this a number that operations had a role in building, or is this information that finance just handed down and they really don't take ownership when it's that type of, just handing down the number and just pushing the number down from finance. If they didn't have input into what the number was and how the plan was built, it really is hard for them to take that ownership that they need to take. But this type of tool allows you to see exactly how it was. And then there's also something called an audit trail that allows you to see who put the information in, when they put it in. So having that transparency to be able to have confidence in the numbers is critical to these types of systems. So I'm going to go back now to the SMART practices. We're going to go over to SMART practice number 3. Now, SMART practice number 3 is to create driver-based plans that you can drill and flex. This is critical to the organization's ability to do the plan or to build the plan in a timely fashion, and also to understand their organization. If all you do in your planning process is you look at dollars and you think of things in terms of dollars, you're missing out a great opportunity to drill into the business activities of the organization and understand exactly what makes it work and what drives you from those baseline day-to-day business activities all the way up to the success of the organization that does get measured in dollars on the financial reports at the end of the year or at the end of the period. So creating a plan that helps you link those things together helps finance understand the organization, but also builds that business acumen that we talked about earlier in the operational leadership and helping them understand the relationships between what they do and the results that they produce. So creating driver-based plans helps with that, but it also helps with the timeliness piece of this and the ability to be able to flex those plans and to drill into those plans like we just did with the dimensionality piece. That's all kind of part of a driver-based system or plan that allows you to see the information from different angles and different slices and understand it much better. And we were looking at a pretty high-level, simplified approach to this. I've seen personally a lot of plans that go into some more detail or that are much more sophisticated in terms of how they're built out, and they tell a lot of information about the organization, just the way that the dimensions are laid out and the way that the drivers are built. So it's important that you think thoroughly through that as you're building out your driver-based plans to be effective. And it will change over time, and we'll talk about that in a minute. But right now we have our next polling question, so I'm going to turn it over to Jen.
Okay, so polling question number 3, how are you planning and analyzing now? Excel, legacy enterprise software, custom in-house, or other vendors?
Let's take a look at the results, and not surprising, we've got pretty close to right at about 80% are using Excel. Some are using legacy enterprise software, and we'll talk about the different types here in a bit. And then some of you have some custom in-house, and then some of you have some other vendors that you're utilizing. And the reason that it's not surprising, I mean, I believe there's like 800 million Excel users worldwide. It's a very helpful tool in a lot of ways. The problems with Excel come out as the organizations grow. I was in an organization that used well over 200 spreadsheets in the planning process, and we ran into all kinds of issues from version control to formulas and links getting dropped. And I think the last year that we used Excel in our process, we dropped a few $100,000 worth of executive salaries, and that was the end of that. So it's very useful for the daily or certain types of analysis, but to build out a full model business plan and driver-based plan, it becomes very limited in some respects and not very scalable. So I can't say, that Excel will never go away, let's put it that way, but definitely is very useful in a lot of organizations, but has its limitations. So not surprising at all. In using driver-based plans, it's important to focus on, like I said before, what drives your business. And then we talked about automating before, automating everything else. So if I'm talking, let's say hours are my revenue drivers. So I put another 1,000 hours of revenue for this month for that particular customer or particular region. What is that going to do to everything else? What does that change? That's definitely going to change my revenue. It's going to change my salaries. I'm sure I'm going to have to hire some headcount to be able to perform 1,000 hours worth of work in the organization and services. You might have some uniforms tied to that. You might have other things that get actuated, and certainly within the salary area, you're going to add benefits and taxes and so forth. So that's what we mean by automate the rest. You just enter in the change of 1,000 hours, the system takes it from there and actuates all the other GL accounts and information that needs to be changed in order to fulfill that 1,000 hours. But you also might have some KPIs that come out of that. If I was adding 100,000 hours, am I going to have to hire recruiters to get enough people hired and so forth? So it can develop into pretty sophisticated models if you do it right and understanding that. And understanding your drivers is iterative in nature. You're going to start with what you know at this point, but as you go through this process of building out driver-based plans, you're going to learn more as you go, and you're going to get more intelligence out of the drivers. The drivers may change over time. You may realize that it's not just those hours. There may be other factors that come into building those drivers or working with those drivers. It may start way back in the chain. I've talked to other organizations that use crime statistics as an example, where they're bringing in outside information from the organization, which then drives their knowledge of how their business is going to go into the near future and peering around the corner, as it were, to see what's next. And then being able to drill down to the transactions, drill across the dimensions like we showed you earlier, is important in driver-based plans. Be able to get to root causes. It's not just about understanding that something changed, but why did it change? And when you go through this process, you start changing the way you talk to your operations leadership about their plans. And it's no longer about how much are they going to make and how much are they going to save or how much is it going to cost. It's more of how are you going to achieve these reports or these results? How are you going to do this? How are you going to make this money? And you're really changing the conversation in a good way to help them kind of challenge themselves to understand what is it going to take to get there. And we talked about the business intelligence in the last smart practice. Really, as you look at that process and the driver-based plans, you're going to find out that there are drivers and KPIs at every level of the organization. And they're not going to be the same 3 to 5 KPIs for the whole organization. You're going to look at the individual workers on the front line and the managers the supervisors that supervise them and the managers, and go all the way up the stack in the organization and find out that there's drivers and KPIs at each of those levels that are unique to those levels. And that will help you achieve eventually the results that you're looking for in a more scientific approach and a more methodical approach in how you're seeing it and how you're measuring it and how you're walking through that process and how you're achieving the goals that you want to achieve. So that's where driver-based plans can help you mature in a great way the finance role of the organization. And then the last point on this slide is to be able to conduct on-the-spot what-if analysis, to be able to give the business users the ability to change and develop their own set of plans. In my organizations, I always had the annual budget that the board of directors would approve, and that was something that was tied to compensations and things like that. But then we would peel off and we would do rolling forecasts as we needed to, that were the official rolling forecast, as it were. But from time to time, I would peel off a version of one of those rolling forecasts, and I would open it up to the users, to the vice presidents and directors in those areas, and I'd say, here, you go play with this. And go tell me, what you think about the future based on, your what-if analysis. And then I could do reporting based on all 3 sets. So I can do variance reporting based on the annual budget and the official forecast, and then this what-if analysis that my vice president of that division was able to put together. And they were starting to look at things like, okay, what if I sold this contract earlier? Or what if I got the big one? What if we increase the price, or what if we decrease the price? Would this translate into better sales or more sales or that sort of thing? It was all kinds of different techniques to be able to get to a better understanding of the business and a better understanding of where the business was heading, and then we could do that variance analysis and understand Why are these different? What can we do to get to those what-if scenarios and move the organization even further towards success? In the driver-based plans, we have a quote here from Tiffany that says, in adaptive, you can change a global assumption and it recalculates the entire budget in order to conduct what-if analysis. It's amazing. And what she's talking about is the ability to use not just the drivers but also assumptions within the model. And a lot of those are tax rates and things like that, but also it could be factors that we talked about recruiters a while ago. If I put on 50,000 hours into my plan, I could have an assumption, a factor that says I need to hire more recruiters to bring on more people, and in my hiring process, it's going to take me looking at 100 candidates to be able to get to 10 hires or something to that effect, and walk through that process. So you can have pretty sophisticated plans, driver-based plans, using those assumptions and recalculating it just by making a few changes on the fly. So it's very critical to be able to do that. So now we're going to talk about the fourth SMART practice. That is to drive enterprise-wide collaboration. In most organizations, and especially those of you who are using Excel, the finance people or professionals take the brunt of the work in the planning process, and that's the way it was for me for a long time, where I was putting all the information together, building out the models obviously, but I was gathering information, and a lot of times in that process, one, it had its limitations from a timeliness standpoint, but also I may misinterpret things from the operations staff and enter things in that weren't necessarily accurate just because I didn't understand what they were telling me about something. And maybe we were having conversations that were more anecdotal in nature, and I was translating that into information that really didn't reflect the reality. Sometimes that had to do with their ability to explain what they wanted to and needed to in a way that translating that operational speak into the finance speak sometimes. But there was something lost in me doing all the work, or my team doing all the work in the planning process. And so what we learned is that to be able to drive enterprise-wide collaboration is critical to the whole corporate performance management process. To be able to include as many as you can in that process, not only from an input standpoint, but also from an output standpoint. So as we go through the planning process, we start with gathering the data, and we start with updating it and making changes and going through the approval process. But eventually you're going to get to where you're doing your variance analysis during the year, and it was important that we transition from that monthly reporting of financials to the timely reporting, self-service reporting, as it were, of not just financials, but the KPIs and the metric data and the driver data. And when you're able to do, for example, variance reporting on drivers, you're able to eliminate the price volume distortions that you get when you're just doing variance analysis on dollars. A lot of times you see a variance in the dollar side, and you're not sure if the price mix changed or the volumes actually changed. And many times it's a combination, and a lot of times that information gives you a lot better understanding of how to correct the variance going forward. So, that enterprise-wide collaboration is key to maturing your ability as a finance professional to influence the success of your organization. And I wouldn't discount it. It seems like in a lot of organizations that they are really sometimes skeptical of that process, but the ones that really get it right and the ones that have been able to mature past that and really add value to their companies have been able to do that within enterprise-wide collaboration. So before we go on to this into this a little bit further, I'm going to switch over to our next polling question and turn it over to Jen.
Do at least 50% of managers with spending authority participate? Yes or no?
All right, looks like we got most of the results in. Still coming in. Okay, there we go. Okay, so 65% of you said yes, and about 35% said no. So not surprising. We see this change vary from time to time. I mean, I've seen, usually I'm closer to 50-50 on this, but that's good that 65% of you have that. But it's important that those managers with that spending authority participate in your planning process, and to be able to add value to that process, and to be able to add timely information to the plans. So the other piece that I didn't talk about and is the ability when you have enterprise-wide collaboration is that direct involvement of the manager drives accountability for results. And a lot of organizations see accountability as a bad thing, but really it's not. It's more about how you frame that accountability. Accountability is important because it's that ownership that we talked about earlier. It's really having managers who are focused in on what they need to be focused in on. They own it, they get it, and they are working towards the goals that you want them to work towards. And they are working towards achieving the results that you want them to. And it's kind of, the old cliche of the difference between a career and a job. If you've got someone in here who doesn't have buy-in, doesn't have accountability, it isn't accountability minded, it really just is a job for them and they're just filling space. What you really want to do is involve them and get those managers kind of thinking in those terms, and that comes about with their participation. When they have a say in those numbers, when they're actually entering those numbers into the and there's that collaboration, there's that back and forth, the conversations that go on, and the discussions that go on about the numbers, and we talked about not just how much are you going to do, but how are you going to achieve those things. That builds that accountability within the organization. And you get managers that own it, and you will see your organizations transform. You will see your company's success transform. It's a very important part of this process to get that buy-in and get that accountability in your organization. And then the easy-to-use interface means that all managers can participate. Now, if your system, i.e. Excel or other systems, are not easy to use, you're going to struggle and have a hard time getting collaboration. I learned this from experience. I told you earlier that I was in one particular organization, we had over 200 spreadsheets in the process. That was very arduous. It was very difficult to get managers to participate. They didn't want to keep track of which Excel spreadsheet they had updated with the latest information. They didn't want to keep track of how that flowed and who they had to send it to and all this other stuff. It was very hard because it was very manual. It wasn't very user-friendly. We actually moved from that process into a legacy system, one that everybody would be familiar with, that's sold by Oracle. And it was a great system in terms of functionality, did a lot of things, but it wasn't very transparent, and it wasn't very easy to use, and we ran into some of the same issues that we had before. And it wasn't until we actually moved into Adaptive where we were actually able to use that easy-to-use part of the interface really drove that participation. And Adaptive has a 98% customer satisfaction, which you don't get unless the users are happy with the system, unless they want to be able to use the system. If they're resisting, you don't get those types of numbers. And then alerts and annotations to be able to communicate about those numbers, and having a system that allows you to put notes right on the numbers, and those numbers flow through. So I'm going to jump over into Adaptive real quick and show you what I'm talking about there. So we're going to go into the reporting area. This is kind of one of the ways that we can show collaboration from the output side of things. So in this solution, you're able to build out reports just like you would in any system, where you can click on them and see exactly what's going on for that particular month. So this is something that's been pre-built, and you can do all kinds of conditional formatting or stop lighting and that sort of thing. You can have dollar variances or percentage variances. You can do many different things, and this is all linked. So if I'm hovering over these, I can drill into these numbers and see where they came from in the background in the system. But also, if you notice down below, there are some notes that have been entered into the system. These notes have actually been entered back in the planning area and in the actuals area, where they can attach notes to a specific number. And because this is a relational database, those notes actually follow that data wherever they show up. So if I pull that information in a report, it shows up in that report. And I can have it down here as footnotes. I can also change it to where they're inline notes, so where they're actually next to the account that they're applied to. So if I look here, now I've got some notes here under meals, which is the account it's applied to. So you can have them show up in different ways that way, which is very helpful. Also, the system that you use should have ability for the managers and the operations staff to be able to build their own reports. And so I'm going to pop back in here, go back into the reports. And again, you can see that there's a lot of different types of reports that I've already pre-built. But if I want to go in and build a new report, it should be something that they can do, and it's fairly straightforward and fairly easy for them to do. I'm just going to do this quickly. So I'll build a simple report just to kind of show you how this works and how you should expect the system that you're using to be able to do this. I'm just going to drag over my revenue. I'm going to put some time into this, let's say the first quarter here. And then I want to make this a variance report, so I'm going to bring in my actuals. I'll bring budget, and I'm going to bring in variance, and I'm going to rename this real quick so that it's not a long name. I'm going to hit run. Now this came out a little different than I thought it would. I've got my actuals and working and variance on top, so I want to make a change real quick. Switch this out. So in a matter of 10-12 seconds, I built a variance report for the months of January, February, March, and the first quarter there with my revenue. Very easy, very straightforward, drag and drop. This isn't something that I'm going to forget in a year. Because a lot of systems, you get this reporting tool, you're able to use it, you build about 10 reports, and a year later you forget how to build those reports. You need something that they can use that's very easy and very simple to remember as to how it's used. That's the reporting. So let's go back over to our best practices or smart practices, and we'll talk about our fifth one here. So what I was just doing is going through the reporting process. This also speaks to the smart practice number 5, which is enable that self-service or on-demand culture. And having the managers to be able to go in and pull their own reports is important, is also helpful. They can pull things that they need to see when they need to see it, and they're not relying on accounting or finance. I know most of you probably spend a lot of your time answering requests for reports, and having people come up, take your time, take time out of the day, interrupt your day, whatever it is, and ask for reports that they need urgently. And in most organizations, there's a bottleneck in that process. There's not enough people in finance or in IT that can pull the reports, and so people are having to wait for their information. and that obviously hurts their timeliness of the information that they're needing. But also, it's not just that, but usually in most organizations there's a standard set of reports that gets pulled, and they're not able to experiment. If I were to go back and share that real quick, I'm just going to pop back over there and show you that in the report writer that I was looking at, I've got access to every element that's in this system. So everything that I've put in here, not only I showed you about the accounts, the GL accounts, but there's also metric accounts and my KPIs and the assumptions that we talked about earlier. I've also got down here below the custom dimensions that I built into this model. So I've got my customers, I've got products, I've got locations, whatever it is. So if I want to see product sold by location, I can pull a report and write a report on that and see it exactly. Or if I want to do it on prices, I can do it exactly the way I need to see it. And that allows your operations staff to get to the information they need to when they need it. That's very important in terms of building that self-service, on-demand type of culture. Before we go on, let's go ahead and take our final poll here. Jen?
How is data accessed by your employees? Request finance or self-serve apps?
All right, let's go ahead and take a look at the reports or the results here. And not surprising, this is exactly how it was for most of my career, and that people were asking finance for all this information. And in reality, when I made that transition over into self-service, it really transformed the business in terms of how information flowed and how timely that information was and accuracy and so forth. So being able to transition from where finances were providing everything to giving the managers power to be able to get the information themselves really helped us turn that 80-20 rule that we talked about earlier, where we were spending 80% of our time working with data and 20% of our time analyzing. Helped us be able to swap that around and be able to do that. So thank you for answering that poll. You're also able to put the business users in the driver's seat with their own analysis. And that's really what we're after, because they know their business better than finance will ever know it. I mean, finance is not created to know the business and know the business activities, day-to-day activities, and how the customers work and how the competitive landscape is and all that stuff. It's really up to the business owners to own that process and business users to be able to develop those skills and those tools to analyze their data. And so being able to do that from a self-service or an on-demand basis really empowers them to do that. And then, like we talked about earlier, I'm not going to beat a dead horse, but easy use interface is really important in this process. It requires minimal training, because in most organizations, like I said, they don't use it frequently enough where you might have turnover, and you're always training on your reporting tools. Well, give them a tool that you don't really need a whole lot of training on. You just show them how to drag and drop, and they've got it. So that's helpful. And then reducing the strain on finance and IT is part of that. So real quickly, just the evolution of corporate performance management, business intelligence solutions. We talked about Excel. It's easy to use, but it's a manual process. It's a lot of errors, non-collaborative, doesn't scale very much, and it's not secure. So it doesn't have the security features that systems will have. The legacy systems like Hyperion or Cognos or Business Objects, these are very powerful, got a lot of features, but they're very expensive. They're highly complex, slow to deploy, hard to use, IT intensive. A lot of times I had to rely on my consultants to be able to make changes in my legacy system. And then the cloud solutions that are coming out these days are very easy to use, especially Adaptive Insights here we're featuring, and powerful. I did not lose any functionality moving from the Oracle product over to Adaptive Insights. They were quick to deploy, about 1/5 the time to deploy. IT was not required at all, and then I was able to scale them. I mean, some of the largest organizations out there, Coca-Cola, Toyota, a lot of huge names out there using Adaptive Insights. So all the way down to very small organizations and companies that are using it. So it scales very nicely. And then because it's a cloud solution, you're always up to date with the latest and greatest. Continuous innovation. So what we've really been talking about today is what are the practices and technologies that allow you to add that value and mature across those cycles that we talked about in the very beginning in the role of finance, and how you can mature your part of that role of finance in your organization, in your company. That's with use of rolling forecasts, automated KPIs, driver-based plans, collaboration, and finally self-service. So at this time, we'll go ahead and turn it over to any questions that we might have. Jen?
Okay, we would now like to give you guys a chance to ask some questions. In order to ask a question, please submit your question via the chat box on the bottom left corner of your screen. If we don't get to your question during the webinar, Paul will follow up with you via email. We do have one question from Brandon. In your experience, would a company typically need to grow to a certain size before it would make sense to use a tool like Adaptive Insights for its forecasting, as opposed to forecasting exclusively in Excel? We are a small company, and I have evaluated Adaptive Insights in the past, but so far our forecasting pain hasn't been enough to justify the cost.
So that's a very good question, and it's actually difficult to answer because the temptation is to do that in terms of measuring revenue. But I've had companies that were pre-revenue that had this solution. I've had companies with as little as 5 employees that were using the solution. So it's really hard to answer. It really comes to the point where you're trading out the time you're spending doing the planning process and analyzing and gathering all the data for that analysis. So if in your organization you feel like you would add enough value in your ability to transition from that data gathering piece to the analysis phase to justify the cost, that's the point at which most organizations make that transition. I can tell you for typical revenue generating organizations, it's usually 10 million and above. But again, it's really hard to say that emphatically based on the experiences that I've seen and people out there using the solution. There are over 3,000 companies out there using Adaptive, and it's growing very quickly. So there's still a lot of room out there for growth, but there's a lot of companies out there using it in all different sizes. So great question. Another question I see that is this built for specific industries? And no, actually, the Adaptive solution is pretty agnostic when it comes to industries. I mean, I've seen it used in so many different ways. I don't see an exclusion in terms of industries. Anything from nonprofits to oil and gas. I mean, you can build out ARO models in this, production models where you're putting in wells and it calculates your initial production risk and all those types of things, all the way to manufacturing, service organizations. It really works well there. So it's really agnostic when it comes to that. So, but great question.
Okay, thank you, Paul. Any other questions? Okay, it looks like that's all the time we do have for questions. Please check your inbox for a follow-up email with an evaluation form. This form must be submitted in order to receive your CPE certificate for the course. Thank you all again for attending, and have a great day.